Tony Ferguson, who's going to be hosting today's webinar. Thank you for coming along. We do record these sessions for people who can't make it, and we put them on our BIPC website as well. We will have times for questions at the end, unless Tony asks you any tricky ones halfway through. Unfortunately, today I'm not going to be able to stay because I'm at an event down in Barrow at the Forum. So I'm here as Master of Ceremonies. But we also have Sophie Baker on the call, who is the BIPC advisor from Carlisle, who will be looking after everyone. Not that Tony will need any help in that. So the chat will be monitored, but sometimes while people are sharing screens, we can't always see it. If you want to raise your hand, please do so. And we put all of these on our website, as I said. So if there's anything you want to refer back to, that'll be there for you. And without further ado, I will pass over to you, Tony. Thank you for doing this. Tony is on our panel of experts in residence, and he shows people through the business side of stuff. And he's going to talk to you today about the accountancy side of things. Tony, over to you if you want to share your screen.
And there we go. How's that?
Yep, I can see it. I hope everyone else can. I'm sure you'll get a thumbs up.
Excellent. Thanks very much, Ben. So yeah, as Ben said, I'm Tony. I'm an accountant. I work at Dodd & Co, which is based in Carlisle. We also have offices in Penrith, and we deal with clients in Cumbria, but much further afield. And I get involved in small business startups. So anybody who is thinking about setting up in business, I would speak to them. Basically covering all of the different bases. So what are we going to cover today? I'll just flick through my slides. We have got some good looking guy there. Yeah, that's me. The session outline for today. When I'm looking at being self-employed, what does it actually mean? I do try and keep these sessions very, very informal. So if you do have any questions as I go along, try and pop it in the chat and I'll answer it as I do. If not, we'll try and get some questions at the end. We do have quite a lot to pop through today. So yeah, what is self-employment? I'm assuming no knowledge at all. We're going to look at forecasting income. We're going to move into the different types of business structures that could be adopted by each and every one of you. And then, yes, I have had 7 years in the tax department at Dodd & Co, so I'm going to bring in some numbers, looking at dates and deadlines, the important questions that people want to know as they're setting up their businesses. Also, we're going to look at allowable expenses. What would be an allowable expense for tax purposes, which would reduce profits and reduce your personal tax liabilities? That's normally something that gets quite a bit of interest in these sessions. We're also going to be looking a little bit at recording transactions, and we'll be touching on MTD, or Making Tax Digital, which is something which may already have impacted on your business. If not, it's something that could impact on you in the future. And then towards the end of the session, we'll be looking at a very brief, and I say very brief, a brief introduction to registering your business for VAT, what kind of things you need to be looking at in terms of that. And then finally, we'll finish off by thinking about staffing your business if the business is growing to a point where you need to bring more people into it. So hopefully that sounds as though it ticks a few boxes for you. And I'm going to start by just well, I'm going to start right from square one. What are we thinking about when we think self-employment? So what I see when I meet up with clients are the reasons why they want self-employment kind of focuses around flexibility. It fits around other commitments. Most commonly, I will see maybe a young mother who has been away from work, raising a family, and she's wanting to get back into the workplace, but it needs to fit around the children, the school runs, and all of the other things that happen with a young family. So self-employment is very flexible in those terms, and that's what people tend to like about it. Also, looking through all of these bullet points here, it does allow you to be your own boss. So people like the idea of, I am generating this money and it is all for me. Obviously, you have got your expenses to pay and the taxman wants his slice of it. But in theory, yes, everything that you generate is yours and it doesn't need to be shared between any work colleagues. So that is usually a kind of a plus point for people. You might have identified an opportunity. So there is a gap in the market that you think you have got the skills and expertise that you could use to plug that. And particularly in Cumbria, these skills and experiences tend to be in the artistic and the creative sectors. So if people are wanting to move away from the mundane 9 to 5 admin-based roles into something which is a little bit more artistic or creative, that tends to be what we see up here. So that might be one of the reasons why you're going into or thinking about self-employment. Do you want to make millions? I say get in the queue and let me know when you've made your first million, because I want to be your friend. You can take me to the pub. And the final point here is to beat the competition. So you may think that somebody's doing something, but you could do it better. So those might be the reasons. Those are things that commonly come up when I'm speaking to a new business client. If I can then maybe flip that on its head and play devil's advocate for a moment, I would then say, well, what about employment? What are the advantages of employment that you may not have in a self-employed capacity? So the first thing that we would look at is, as an employee, I am an employee of Dodd & Co. I get my regular wages. I know at the end of each month, my money, well, my wages will go into my personal bank account, and I can structure my life around it. My direct debits can be set up when I know the money is there. And at the early part of the month, all of my payments go out, and whatever's left over is playtime money. So it's quite good from a planning perspective. If you are self-employed, you will only get the money if you have done the work. If you don't do the work, you don't collect the debts in. So, you know, your credit control needs to be really tip top to have the money in your business bank account in order to get that money for yourself. So cash flow into the business bank account is really important in order to pay yourself the wages that you need. Also, if you are employed, there is a minimum wage guarantee. So anybody who is over the age of 23 will currently be receiving at least £9.50 per hour if they are employed. If you are self-employed, there is no such guarantee. You are generating your own money. Also, if I am unable to work, I am off sick, touch wood, that will not happen, but under my contract of employment, I could have some further payments. As a self-employed individual, you would still be entitled to sick pay, but you would need to speak to government departments, Department for Work and Pensions, in order to tell the powers that be that you are unable to work. There would be hoops to jump through, and it is quite a laborious process. And your sick pay would be a statutory level unless you have got some personal provision in there for sickness pay. So that's something to look out for as well. We've got paternity and maternity pay. If you're taking time away from the business, are you going to be paid? Where an employed person would have something along those lines within their contract of employment. And also think about your holiday entitlement as well. Is this something that you need to factor into your business plans, your forecasts? What time away from work will you have, and what will the impact be on your future income? So it may be that you're working for a long time when you start up in order to build up the funds to have that contingency in place, which means that you can then take money, take holidays, take time away from your normal business. The final point on this slide is really important. So it's become more important over the last few years, and that is with regards to pensions and auto-enrolment. So the rules for auto-enrolment were introduced maybe about 6-7 years ago now, which means that anyone who is employed, who meets certain criteria, being full-time employed over a certain age, must be enrolled into a workplace pension scheme. So you would have deductions from your wages which go towards a pension for you when it comes to retirement age. If you are self-employed, you would need to look at something like that yourself, and it's something that you may lose out on if you don't have that pension in place, because the state pensions, unfortunately, are not going to be there forever. The age at which you can access your state pension is going to be changing. Is it going to be 65? Is it going to be 70? Depending on how old you are, your state retirement age could be up into 70s, 80s. You may not even get anything at all. We'll just have to wait and see. But yes, if you are employed, you will have or you should be auto-enrolled into a pension, and your employer will also be making contributions into that scheme for you. So again, that is another benefit for being employed. But hopefully I've not scared you off too much, and you are thinking about self-employment. So without further ado, we'll look at the numbers. Obviously, an accountant, yes, I'm going to talk about numbers. So the first thing that I would suggest everybody do is have a look at your own personal circumstances and think about how much money you need. If you were employed, how much money would you be earning in order to maintain your lifestyle? If you are self-employed, you will still need to generate a certain level of money in order to continue this lifestyle. So as it says on the slide here, what regular costs do you incur, and how important is a contingency fund? So if the boiler breaks down, do you have money in your personal account in order to rectify all of these things? I will flip my screen now to a personal survival budget template, just so you can have an idea of what I'm talking about. So this is a personal survival budget, which gives a rough breakdown of various different household expenses that you might have as an individual. So we've got like fairly obvious things: your mortgage, your rent, your council tax, things like that. You've got your general housekeeping, your groceries, but also bear in mind the entertaining things, the meals, drinks, and socializing. Do you have any subscriptions? Thinking again about holidays, Christmas, birthday presents. How much do you spend on that? And try to quantify how much you are spending. I would say go over and above when you write down all of your expenses, because you need to make sure you have got money coming into the house to cover all of these costs. And it's better to overestimate than underestimate and leave yourself short. So if you list out all of your anticipated expenses, and then at the bottom, we've got estimated income. So it may be that you have got a spouse or a partner who brings in money to the household as well. You would have your income, they would have their income going into maybe a joint pot on which all of the household expenses are paid out. You may have family allowances, child benefits, or any other kind of universal credits or benefits that you are entitled to. So take those into account as well. And hopefully the amount that you need will be something that is manageable. So that is your personal survival budget. I will flatline that again. So once we've got an idea of where we're going to be spending our money, we need to think about where we're going to put our business money. So the next slide we've got here is business banking. Will you put your money into a personal bank account? The banking code of conduct would really have something to say about that. Ideally, what the banks would like is a business bank account to be set up. Why is that? Well, there's a couple of reasons. It's good to keep things separate. As an accountant, there is nothing worse than me having to look at someone's bank statement and separate out that's a business expense, that's a personal expense. So having that separation is a good thing. Also think about what HM Revenue and Customs would do. HM Revenue and Customs would look after the tax returns that you submit. They would make sure that things are looking reasonable and as they expect them to look. If there is any queries, they could investigate your tax return. And if you are investigated, one of the first things they will do is look at your bank statements. That would be the audit trail for all of your business transactions. So it's a good idea. It provides comfort to HM Revenue and Customs, and you're not stashing your cash underneath the mattress or hiding it in a safe somewhere. The revenue would look at that and say all of your business expenses and income are going through this one account. Why do people tend to shy away from it is because normally there are fees associated with business banking. Typically, your basic fee would be about £5 or £6 per month, depending on which bank you are going to. But do bear in mind, if you are a new business and you speak to your bank and let them know what you're doing, you will normally get a period of free banking. You can get about 12 months from most high street banks, possibly up to 18 months. So definitely look into that and see if that's something that would be beneficial to you. As I say, normally about £5 or £6 a month for basic banking, but it depends how you use that account. If you are putting cold hard cash into the account, then the fees will increase because you are using the counter service, you're using the staff, you're using the employees. Similarly, if you are writing out a lot of checks, we tend not to see that so much now, but there are certain industries, particularly in the agricultural sector, where checkbooks are used very, very regularly. And the processing of the check, it's time consuming, and it also means that you are using the bank staff and the bank fees could increase. So how do we keep our bank charges to a minimum? Is basically by doing all of that work yourself. If you can have your customers paying you by direct bank transfer, the money goes directly into your bank account. You are not having to take cold hard cash to the bank and put it in. It just keeps things simple and straightforward. Similarly, by making your bank payments by a BACS transfer or just a general bank transfer, then that means that you're doing the work of the bank. You are just using the bare bones of their facility, so that the cost will come down as low as they possibly can. I've got a bottom point on this slide. We've got high street versus online banking. So yes, the high street does tend to have a lot of bank charges, and we've got these new online bank accounts which may lend themselves to your different types of business. So in particular, thinking about Starling or Monzo or Metal, those are the ones that we tend to see coming through at this point in time. And if you do not need any borrowing, there's no lending requirements from the bank, then there's nothing stopping you from using these bank accounts, setting up a separate business account, and hopefully the fees would be minimal. So that's your banking side of things. Just make sure that you've got some kind of facility there, and a way that you can store all of your money, and you can access that as an audit trail, because that will form the basis to your accounting records. So moving on, yeah, I've got a cash flow forecast to think about next. So we've already looked at our personal survival budget. That's our own money. We're managing our own money and we're taking cash from the business to live. What about the expenses of the business, and what about the income from the business? We need to have an idea. So before we've even set up in business, we need to make sure that it's a viable business. So we would encourage people to do some kind of cash flow forecast. Again, I'm going to change my screen. I've got a basic Excel spreadsheet, which I've just knocked up, where I can show the blue cells is your income and the red cell shows your expenditure for the business. So we can see that in the month just ended, January 2023, I have got sales income, anticipated sales income of £500. I think I'm just a new business. I think it's realistic to assume that that is what I can generate. Do I have any income from interest? Probably not, because I'm a brand new business. I've got nothing in my business bank account at this point in time, so no interest there. I have not sold any fixed assets because I'm a new business. I'm just starting to trade, so I'm going to be buying all of the fixed assets that I need. So those are things that might happen in the future. It's just there as a reminder to me to think about those. Where else could I get money from? So I've got a loan in the business, £10,000, and I've also got some capital introduced. That might be money from my own savings. I've got a point there for other income. So other income may be some kind of grant that you've received. There are certain places that you can go to receive money if you are a business startup and if you meet certain criteria. So again, we've just left a little space there to say that that could be something else going into the business. So we're anticipating, using this example, January 2023, £11,500 worth of money to come into that business. In an ideal world, that would go into a business bank account and we would see that 115,500 showing as income. What have I got in the red boxes? I've actually got some anticipated expenditure. So purchases, presumably I'm going to be some kind of retail business. I'm going to spend about £5,000 for my stock in my shop. I have a contingency plan here of about £100. £100 for sundry items that I don't know. It's just there as a fallback plan in case there's some unforeseen costs that arise. I've got lots of other types of expenditure, which we'll come back to later on, but this is just something to make you think, what would be your business expenses? Telephone costs £100, heating and lighting £600. Is that realistic given the cost of living crisis and the increases in heating and lighting costs? That's something to think about. Rent and rates. So do you have business premises? Do you actually pay business rates, or could you qualify for a small business rates relief? We've got some cleaning in there, some legal and professional fees. You may have a solicitor, an accountant, an HR advisor, anybody who's doing something that you've outsourced your professional requirements to, then that could be a cost that the business incurs. We've got some other bits and pieces to think about, but importantly, probably most importantly on this screen, is the money that you take out of the business for yourself. So we've talked about the personal survival budget. Maybe you need minimum £1,000 to be transferred out of the business bank account into your own. In this example, we've got £1,500, and we can see that the money is taken out in a variety of different ways. We've got drawings, we've got a director's salary, and we've got dividends. We will touch on those very soon. It just depends how the business is set up. If it is a limited company, you will probably be taking your wage out by way of a payroll contribution, or you may actually take dividends. That's for limited company. If you are a sole trader or a partner in a partnership, any money that's taken out of the business is your drawings. So it's just a bit of a moot point. Basically, it's money taken for yourself is what I'm getting at. It's just called different things depending on how the business is set up. So overall, in this example, I have got £11,500 coming into the business and £8,301 being taken out of the business. If these figures are correct, you'll see in the yellow boxes that I have got a net inflow of cash into my business bank account of £3,199. I will flip my slides and you can see that I have now expanded this to look at not just January 23, I am looking over a full year through to the end of the year here in December 2023. So you can see that in each of these columns representing 1 month, my sales income has increased. So I've said an increase in February and it's kind of bouncing around that level for the rest of the year, maybe peaking a little bit towards the end of the year, October, November, December time. So thinking about your own business, are you having some kind of peaks and troughs in the business? Do you sell Christmas trees? So your busy time is September, October, November. Are you selling Easter eggs? So you'd have a different time when it's your busy period. Or are your sales going to be roughly consistent throughout the year? Now, this will be different for each business, but when you prepare your cash flow forecast, you can build in these peaks and troughs and you can find out when you are likely to have a lot of cash and when you are likely to have a shortfall that you need to think about when you're planning for holidays, time away from the office and such like. We've done similar things with the expenditure. Obviously, we've got a lot of purchases at the start of our business because we are stocking our shop. Maybe when the shop is up and running, we don't need to spend as much money on purchases because we're just stocking up the things that we have sold. So maybe the purchases figure is not going to be as great moving forwards. Sundries, we've identified £200 in the first 2 months of trade and then nothing thereafter. So hopefully things will settle down by month 3 and we'll know where we are and we can identify any regular costs or any unforeseen things. We can put those into this forecast again. We've got some other costs in there, the telephone costs, the heat and light, rent and rates, and the director's money or the business owner's money taken out for themselves, £1,500. An important point to note is that we've taken out the £10,000 loan in January. We don't start making repayments until we get into July 2023. So maybe there's been a 6-month holiday before we actually start to make the repayments on the loan, but we reflect that in the cash flow because we're identifying that payment in the future. If you prepare a cash flow like this, we can see kind of easily when we have a shortfall in cash or when we actually, you can see here that we go into negative figures when we start making these loan repayments. We have a net outflow of cash in the month of July. So we've paid that £1,800. Fortunately, we've built up money over the first 6 months of the year so we can cover those costs. So this is something that a bank manager or a finance provider would look at your cash flow forecast in determining whether or not he would be able to give you some additional funding for your business to help with working capital. That is the cash flow. It is a working document, a living document, we tend to call it. So if you identify something that's kind of changed significantly to what you anticipated, we would say reflect it in your cash flow forecast moving forwards. I've got a final tab on this spreadsheet, which is the same figures again, but what I've done is I've put the grey columns in beside each of the months, so I can look at what we anticipated the income and expenditure was going to be versus what the actual income and expenditure is. So I won't look at all of them, I'm just conscious of time, but if we look at January, we can see that my sales originally anticipated £500, it was actually 750 that was received. So great, we're doing better than we anticipated. We also thought we'd need a loan of £10,000. It turns out that we only needed 8,000. So great. Again, we're not having that liability of repaying the loan. It's not as much. And then we can see that capital introduced, my own savings, it was supposed to be £1,000, but I've actually been able to squeeze together £1,500. So I'm in a better position with regards to putting my own money into the company. It gives the banks, it gives the finance providers a lot more comfort in what they are seeing. You can see, looking down at the purchases, I've not spent as much money as I thought I would. I did think there was going to be £100 for miscellaneous spend, but there hasn't been anything else. And then the telephone costs are slightly lower. Heating and lighting, it's higher than I anticipated. So as I said earlier, we've got £600 being budgeted every month for heating and lighting costs, but actually we're looking at 740, 763. So maybe we should amend our cash flow and show heat and light anticipated at £750 a month going forward, just to make sure that the cash flow means that we can have enough money in there that we're working towards some kind of profit. So that is your cash flow, which again, we could go into that in a lot more detail. And if you do want to do something like that, if you wanted to chat with me, have a word with Ben or the guys at BIPC, and I'm sure they'd be able to help with arranging something. So the cash flow forecast, it looks at when money goes into and out of your business bank account. When you're preparing something like this, you've got to consider, are these figures realistic? Can you build in a contingency? I would always suggest that you underestimate your sales and overestimate your expenses, because then when you get the actual cost and you have generated more money than you thought, or you have spent less money than you thought you would have, it's always a bonus for you. But when you're looking at the costs, do as much research as you can. What are the rents going to be? What's the rateable value of this premises? What are your phone contract costs? And then when you're looking through that cash flow forecast, is there going to be a shortfall? Are you going to go overdrawn? Do you need to inject more capital yourself in order to see you through this period of being in the red? And can you pull yourself back into the black? My next slide was the example cash flow, which we've already looked through. So all of this is the planning side of things before we even get to registering a business. And that's what I'm going to look at next. So with various different types of business that we can have, essentially, we've got a sole trader partnership and we've got a limited liability. We've got each of those and they're in a separate bubble each, because the tax on those, the responsibility for each of those are very different. But these are the main ways to operate in business at this point in time in the UK. We have also got a lot of businesses that work in the third sector. So maybe you're thinking about setting up a charity or a community investment company or something that does something for the general good of a group of people. It's a lot of people want to give something back now. Third sector, we're not dealing with that today. That could be another session. It could be a massive session. But what we're going to be focusing on in today's remaining half hour is sole traders and partnerships versus limited company. So if we start with a sole trader, that's the most simple way to operate in business. What are your legal requirements? All you have to do is complete a tax return and pay your tax on time. And it sounds so easy when I say that, but people do get themselves in knots because there are implied responsibilities behind what I'm saying are the legal requirements. So submit a return. Yes, you can submit a return, but what goes on that return? You will need to know that everything goes on there, whether this is employed income, self-employed income, rental property income, investment income, it all goes on there. There's certain things that don't go on a tax return, and that would be certain benefits, but you should be told whether or not they need to appear on the return. Child benefit does not need to be shown on there. Any interest on ISAs, because that's tax exempt, so we would not show that on those tax tax returns either. But in the main, all of your income would go onto that self-assessment tax return. When, you'll be setting up a tax return, you'll be assessing yourself. It is your responsibility to complete that tax return. You will sign it and you will submit it. You may employ an accountant or an agent to do that for you, but ultimately the signature, the submission of the return is your responsibility. You are assessing yourself. You are telling HM Revenue and Customs what income you have received and how much tax you will pay based on that level of income. Now, if you are self-employed individual or a partner in a partnership, you will submit a tax return no later than the 31st of January every year. So we have just got through the January deadline time, which for us accountants tends to be one of our busier times in the year. In an ideal world, we would love you all to submit your tax returns before the 31st of January, because if you submit a return and there is tax to pay, that is also the date that the payment's got to be made. So when I've got the bullet point that says when to submit the return, as soon as possible after the end of the tax year. So the tax year runs from the 6th of April through to the 5th of April. We are currently in the 22-23 tax year, and that 22-23 tax year will end on the 5th of April 2023. If you are doing a tax return this year, you cannot do it until we have reached the 5th of April 23. So we can start to prepare the information, but we need to have a set of accounts. This is one of the implied responsibilities that you would have as a self-employed person, to pull together some accounts, to put them on the return, to submit the return and pay your tax. We've got here tax rates currently in force. So the main tax paid by people in the UK is income tax, and the basic rate of income tax is currently 20%. You will pay 20% on all of your income over £12,000 up to about £50,000, £50,270 for basic rate tax. If your income in the year exceeds that £50,000, you'll pay 20% up until the £50,000 level, and you will pay higher rate tax of 40% on everything thereafter. So those are the tax rates for income tax. We've also got to consider national insurance for self-employed individuals. You would pay national insurance class 2, which is a one-off lump sum payment, round about £150 each year, and that would maintain your state benefits and it would count towards your state pension from the government at this point in time. So that's your class 2 contributions. You would also pay class 4 contributions, but you would only pay class 4 contributions if your self-employment profits exceed a certain level. I am thinking around about, I've lost my tax tables. I'm thinking round about for national insurance, class 4 would be on profits above £11,908. So if your profits are above that level, you would pay class 2 contributions, £150 a year, plus a proportion of your self-employed profits above £11,000. We can go through worked calculations if you wanted to, but again, because of time pressures, I've not got time for that right now. I've said when we pay the tax, 31st of January following the end of the tax year. So if you've got a tax liability, you can submit your tax return in April 2023. You will know what the tax liability is because the return will be processed, and you can then start to save money towards paying that tax bill. You can put it on your cash flow forecasts. You can have a separate savings account set up with your business account just to separate that money off. And then you can make the payment in January before any deadlines. If you do exceed a deadline, if you miss filing your tax return, there will be an automatic £100 penalty levied on you. And if you miss making any tax payments, there will be interest added to the amount of tax which is due to be collected by HM Revenue and Customs. So it really is good practice to do your tax returns really early, as soon as you possibly can after the end of the tax year. Particularly so if you have losses. So losses in a self-employed business can be utilised, they can be carried back, they can be set against other income arising in the year. And if you have paid tax in the previous few years or in the current year, you may be entitled to a repayment of tax that's already been paid. So again, if you submit your tax return early, as soon as you possibly can, That once that gets processed by HMRC, they would then come back to you and say, yes, you are entitled to a repayment, and they will send that repayment out to you. You do not need to wait until the 31st of January to receive that repayment. You get it as soon as the form's been processed. So again, get your account done, get the tax return prepared, get it submitted. If you need to make a payment, you wait until January. If the money comes back to you, then it will happen pretty much straight away. How is that? The taxation on the self-employed individual is the same for people in a partnership. The only difference is a partnership is a number of people working together in the same business. They are all registered as self-employed, and they will all fill in their own personal tax returns, which reflect the money that they have got from the partnership. The only difference is there would be a partnership tax return, which all of the partners are jointly and severally liable for completion and submission. If the partnership tax return is late, the partnership is not a person, so the fine cannot be given to the partnership itself. The fine is given to each of the partners within that. So I'm looking on my screen here, I can see that we've got 5 people in the room. If all 5 of you were partners in a partnership and that return was late, each of you would get a £100 penalty. So that's a total penalty of £500. So be very, very careful if you are thinking of setting up in partnership. Just on a tangent on that, looking at partnership work, if you are setting something like that up, have a partnership agreement in place. Just make sure that everybody knows what's going on, how the profits are going to be split, who has introduced what into the partnership, and ultimately what will happen when the partnership closes down, or if a partner decides to leave, how will we decide what their share is that they can take with them. Much easier to do things at the start to avoid potential tension if the business ends on a bit of a sour note. So yeah, that's just something to do with partnerships that you should think about. So that kind of covers in a very, very rough way how the individual or the partner in a partnership is taxed. We had on our earlier slide limited companies there as well. So how is a limited company different to being self-employed as an individual? Well, there is a lot more legal requirements needed for the limited company. A limited company is a separate legal entity. So it is nothing to do with you. So if me, Tony, sets up a limited company, I am an individual in my own right, but the company exists separately to me. It deals with its own taxes and it deals with its own returns and it prepares its own accounts. I would need to operate that company and I would need to take money out of the company, but technically I would be employed by the company the same way as if I went to work in another big firm and I became an employee there. I would be paid underneath PAYE, which is like normal wage slips where tax is deducted at source. The limited company itself would pay corporation tax. And corporation tax is paid on the profits of the company. There is no personal allowance, so there's no 12.5 grand tax free. All profits are taxed to currently 19%. There will be a change in the rates of corporation tax payable by companies into the future, which will be on a sliding scale from 19% up until about 25%, depending on the size of the profits. So we can see already that companies is maybe a little bit more of a complex structure. All companies are regulated by Companies House, and when we prepare a set of accounts each year, we must submit these accounts over to Companies House, which are in the public domain. So something that you've got to bear in mind with setting up a limited company is that what you submit can be seen by everyone else. You can look at your competitors' accounts, you can look at anyone's accounts if they are registered on Companies House. Saying that, we are able to submit filleted accounts onto Companies House, and that makes things a little bit more palatable to the limited company owners. Limited companies cash extraction. So I mentioned earlier that I would be an employee of the company. I will take a salary out. That's great. The salary would fall under normal income tax rules, basic rate 20%, higher rate 40%, but it may be more beneficial for me as a director to take money out of my company in the form of a dividend. So dividends I can receive £2,000 every year without paying any tax on that. I could also take out dividends, and the normal dividend basic rate is about 8.25%. Sorry, 8.75% at this point in time. So it's better to take the dividend at 8.75% tax rather than take a salary and pay 20% tax on it. So there's a lot of tax planning involved in setting up a limited company. That's all I really want to say on that now, because I'm moving on. I am swapping over to looking at a set of accounts. So regardless of the business structure that you've adopted, whether it is limited company, partnership, or a sole trader, you will need to prepare at least an income and expenditure account. You would need to prepare more than this as a limited company. You've got to prepare accounts under certain accounting standards, FRSs, but the information that is reflecting is going to be the same as a simple income and expenditure account. So what people like to talk about is what expenses can I claim? You would list all of the income generated over a 12-month period, and you would knock off allowable business expenses. So remember that they must be allowable expenses. And if your tax return is reviewed and someone at the revenue thinks that that is not an allowable expense, HMRC have got the power to revise your tax return, normally to collect more tax from you. So be very careful when you're claiming expenses. The revenue say that the expense has to be wholly, exclusively, and necessary for the purposes of your business. An example I like to use is if I were to set up as a self-employed bookkeeper, a self-employed accountant, I would not be able to claim dog food as an expense for my business. It's not something that is necessary for me to operate. But if I were to set up business as a dog walker or a dog grooming salon, then it's altogether possible that I would need to have a stock of dog food in my business. So that would then become allowable. So it's not a one size fits all. There is a lot of what do you think? It's a judgment call for your business. Is this for business or is it personal? So what kind of things do we think about? We've already looked when we had our cash flow forecast on the screen at the different costs there. We've got purchases of materials. There might be some stationery. There could be telephone costs. Think as well about any subscriptions that you may have. Think about your computer software, which we'll touch on in a moment. Entertaining costs are a little bit tricky. So are training costs. There are specific rules that HMRC adopts where they will disallow proportions of these costs if they are deemed to be entertaining or if they are training for brand new knowledge for you. So that's something to think about. I would suggest that everybody needs to consider putting something through their accounts for using their home as an office. HMRC has some guidance on that, and you can have a flat rate expense of £6 per week, which you can put through as an expense. You don't actually need to make a physical payment. It's just what we call a journal entry that we would put through the accounts in order to reduce the profits and reduce the tax liabilities even further. Also, bear in mind that some of these costs might have an element of private use as well. So if I were to put through my telephone costs, am I using my telephone for purely business? I may have two mobile phones, in which case one of them is 100% business, but it may be that I've got one telephone and I'm using it for personal, to keep in touch with family and friends, but I'm also using it because I need to monitor my social media. I've maybe got a business Facebook page set up that I need to keep adjusting and keeping fresh. So is it appropriate to claim 100% of those costs, or do I need to claim a proportion of them? Also think about your motoring costs. How much time are you using your car for business purposes and for private purposes, and what is the appropriate split to adopt for that? That's going to be different for everybody in the room, but there are also a couple of ways that you can claim your motoring expenses. You might have heard about claiming a mileage. So, yep, if that is the case, keep your mileage record. Ideally, HMRC want to know where you have gone from, where you've gone to over the course of a year, and they would like it ideally written down on a journey by journey basis. If you want to do something like that, there are apps on your mobile phone you can use. So I'm thinking MileIQ or Expensify are two that we've come across before. I think they don't have a cost, or there is a certain level before you start paying for them. But both of these apps will monitor when you are traveling at speed, and when you have finished a journey, they will ask, was that business or was that personal? And you can then turn around and say, well, that was business, and put it onto a schedule. You'll be able to download a schedule at the end of the year that lists all of your journeys. If you were to adopt mileage, that would replace having to list out all of your expenses for fuel, MOT, repairs, insurance, taxes for your motor vehicle. You don't need to do any of that. It is replaced by the business mileage. And HMRC allow you to claim 45 pence per business mile on everything that you have travelled in the year. So think about what's the most beneficial way for you. If you think mileage is going to be easier and it's going to give you a larger figure, then it's a bit of a no-brainer. You would put that through in your accounts and it would reduce profits, reduce tax as well. So moving on from what expenses can we claim, how do we actually record transactions? So I've got a few different options here for you. And I did mention on the first slide that we would touch a little bit on MTD. So you may have seen in the press, making tax digital. So this is something whereby HM Revenue and Customs are encouraging business owners and businesses to use some of these cloud software accounting packages in order to record all of their business transactions. Now, the top left that I've got in there, which is in a little box because it's separate, that's not cloud accounting software, that is Excel. And I love Excel. I've worked on Excel for a number of years now, and I cannot beat it. It's just great. But I have been dragged kicking and screaming into the 21st century, and we do use a lot of these cloud accounting packages now. Why should we use them? Well, it may become law. If your business is going to be registered for VAT, you must adopt one of these cloud accounting packages, and you would then submit your VAT returns using this software. All of these software packages are approved by HMRC, so they are very safe. Your information is secure, or the highest level of security that we can possibly get on these software packages. So have a think about that. What are the pros and cons of using cloud accounting? The downside is it's something that you've got to pay for, and the payment will vary. Free agent, which is the bottom left logo, it does exactly what it says on the tin. It is free, but in order to access the free agent software, you have got to be a business banking customer with either NatWest Bank or the Bank of Scotland. If you meet that criteria, then there's nothing wrong with using free agent. It's maybe a little bit more clunky than the other packages, but it is still accepted by HMRC and does the job. The other three packages, I think they're all vying for the top spot right now, and there are different costs. I understand that you will always get a discount if you go directly to the supplier. You'll get that for maybe 3 months or so, and then it will go up to the full price. If you are working with an accountant, they can normally secure that discounted rate for a longer period, possibly for the lifetime of using this product itself. So QuickBooks tends to be the cheapest one, although Sage can be very similar. Sage has got the reputation behind it. People know Sage from a long, long time ago. Xero is very good as well. QuickBooks, great. What do they give you? They give you reports. You can monitor what happens in your business, and you can look at where your debtors are, where your creditors are. So this is people that owe you money or you owe money to. They link into a business bank account. So if you have got a business bank account set up, they should have a direct bank feed that would come through and talk to your software package. You can then analyze the transactions, and you can automatically create the income and expenditure account, which is needed for your tax returns. So yeah, so the costs of those will vary. Free agent free. QuickBooks, you may be looking between 10 and 15 pounds a month, which is the same for Sage. And then Xero, you may be looking more towards your 20 pounds a month at this point in time. So, you know, there's usually some discounts on. So speak to somebody about it, or just do a little bit of research and see what you can find out about those packages. What I would say is if you do use them, make sure that you get some training on them. It might seem like additional costs right now, but it does reap benefits in the long run. Only got a couple more slides to go now. I am aware that I'm flying through this, but hopefully it's just giving you a flavour of the things that you need to consider. So VAT. What does that mean to a business? What does that mean to your business? Is it something that you need to worry about? So the first question is, what kind of supplies are you making? Are you making supplies of taxable or exempt goods and or services? If your goods and services are exempt from VAT, you don't need to worry about it at all. You can stop listening for the rest of this slide. However, the majority of people will be setting up businesses which do have an element of taxable supplies there, which you need to monitor. If you are providing a taxable supply and you register for VAT, you must add VAT onto all of your goods and services. So standard rate VAT is 20%. If I was to charge £100 for whatever I'm providing, I become VAT registered, I would then charge £120. The first question I've got to ask myself is, will my customers pay an extra £20 when I become VAT registered, or is it going to be a struggle to get that money? I will be charging my clients £20 more, but that £20 would then be paid over to HM Revenue and Customs on my quarterly tax return form. So I am not benefiting from being VAT registered. I am just taking that money and paying it over. There is a slight benefit to me in that because I'm a VAT registered business, as long as I have a formal VAT invoice, I would be able to claim back the VAT that I have paid on qualifying business expenditure. So that would be a benefit. It might make my costs a little bit less. So that would be one reason to register your business for VAT. The second point that we've got here is, do we register voluntarily or compulsorily? You must register your business for VAT if your turnover in a 12-month period exceeds £85,000. So if we spread that out over a year, if you are generating income of £7,000 every month, have it in the back of your mind, do I need to register for VAT? It might be that you consider all of your clients to be VAT registered, so they don't mind paying VAT to you because they will claim it back on their VAT return, in which case you would register for VAT straight away and get the benefit from claiming back all of the VAT on your expenditure. And my final slide here today is about employing staff. There's loads to think about when it comes to employing staff. And what I would suggest is you speak to somebody in human resources. You can find HR specialists who would be able to put you in touch with people, but definitely get in touch with somebody because you will need to have contract of employment drawn up. You will need to make sure that everyone is happy with what's been agreed, and also what happens when staff are sick, when they are taking time off work, when they have their holidays, because you have got a responsibility to pay under the national minimum wage rates. So although you as a business owner, if you are self-employed, you don't have that security of the minimum wage rate. If you employ somebody and set up a PAYE scheme, then you would need to ensure that your employees are paid appropriately. You would also need to set up pension schemes for each of your members of staff, and you would need to pay contributions into their pension schemes. Depending on how many members of staff you have, you may also need to pay over national insurance contributions on their wages. So there's lots more that you need to consider. And is it really worthwhile? The cost of an employee is kind of significant. So you've got to have enough work there for them to generate money in the business to justify them having the wage that you give them. If you give somebody minimum wage on a full-time contract, you're looking at what, £25,000, but then you've got your employer contributions on top of that. So it is significant spend. So think carefully about taking on staff. You would have additional responsibilities. There would be more of an administrative burden because you would need to take into account the tax, national insurance deducted from your employees, give them wage slips, and then declare this in a real-time information report to HM Revenue and Customs. So absolutely loads to think about in terms of payroll. My final slide right now is the help slide, probably one of the most important slides of the presentation. Do not feel bogged down by any of this. If your head is spinning, you have got a really good team in the BIPC that can point you in the right direction and help with all of these things. Build your network, make sure that you've got people that you can talk to about anything at all. It doesn't necessarily mean to be a professional network. It could be family and friends. There might be some kind of group in the industry in which you are going to be working, like a support network thing. Just make sure you've got that there, but don't suffer in silence. And hopefully I have given you a few things to think about. I've got about 5 minutes left in the meeting, so if there are any questions, can I just ask anyone to put them in the chat or give me a shout?
Hi everybody, it's Sophie from the BIPC. On behalf of everyone, just like to say thank you, Tony. That was really fantastic. And it's great to have you on board as our accountancy expert in every respect in terms of finance.